This one's a doozy. I heard that you can purchase an investment property and set it up at the point of purchase so that when you sell it, you don't have to pay capital gains tax on the property. I've never heard of this before. Is this something that you can do?
Okay, so this is quite a complicated one. Okay, so I guess what we have to think about here is that the entity that we're actually buying the property in. So, Chris, if you and I purchase an investment property in our personal names and we hold on to that property for, let's say, 10 years, and then we dispose or we sell that property in the future and we do make a gain, then there's going to be capital gains tax payable in our personal names. Okay, so that then would be taxed at our marginal tax rates.
Mm-hmm.
However, we've got to understand that we can also purchase a property in different entities. So it doesn't necessarily have to be in our personal names. It could be in a trust, it could be in a company, or in some circumstances, it could even be in a super fund, like a self-managed super fund, which actually does allow members to purchase real property. So I think what they may be referring to there is that when it comes to taxation within super funds, okay, when you are in accumulation phase, there's up to 15% tax. But when you're actually in an account-based pension, so you've met a condition of release and you're then potentially retired, or you're in pension phase, there's 0% tax payable upon sale of assets or on income of those assets. So it may be that the property has been purchased within a self-managed super fund and then sold when that person was in pension phase or when they're in a zero tax environment. So again, doesn't mean it's the right thing to do necessarily, because there's lots of considerations when it comes to property, as you're probably going to touch on, Chris. But yes, there is potential.
I'm going to touch on those things. So the summary is, yes, it is possible, but you're not, and it would involve a self-managed super fund. That's the only way I can think of doing it. But it might not necessarily be the right thing to do. Just because you can do something doesn't mean you should do something. And I'm going to guess that this person has heard about this via a property spruiking. They might have seen something online, and there's a lot of that about, and ASIC does not like it at all. And there's been a lot of bad cases where this has gone wrong for people. So it certainly is possible. It would involve a self-managed super fund. Typically, it involves borrowing within your self-managed super fund, which is possible as well. The downside is it gets very complex. You've got risks involved with it. Generally, your cost in doing so is pretty high. And it's actually harder and harder to do to get that borrowing in place. So to answer the question, is it possible? Yes, it is. Should you do it? Well, you should definitely seek some financial advice before doing it. And we see a lot of cases where it hasn't worked out, and we would tend to avoid it. So be very careful on that one.